I will read the instructions. You notice the following market report of crude palm oil futures on Bursa Malaysia Derivative Berhad. Number 1. Using the contract months of March and June, explain how you would create a spread position and identify the spread position taken if you expect that it is narrowing between the months. Number 2. Given that the number of contract for each contract month is 5 and the commission charge is 50 ringgit per contract. If you decide to close out your position on February 2023, calculate the realized profit or loss for the position taken if the futures prices for March and June are 4,125 ringgit and 4,133 ringgit respectively. The last question is B. Discuss briefly how an intermarket spread trader makes profit by entering into the futures market. The explanation is on the next slide. Thank you. Contract. First, let's look at the settlement price. From March 2023 until June 2023, we can see that prices are moving downward. This tells us that the market is bearish, meaning prices are expected to continue falling. Because of this bearish market, we expect the spread between the nearby contract and distant contract to become narrower. When a spread is narrowing, the nearby contracts usually fall faster than the distant contract. So, the correct strategy is to sell the contract today, March 2023, and buy the contract in June 2023. This is called a bear spread or intermonth spread trading. For the question part A2, I will explain. Now let's look at the trading position. Today, in November 2022, we open our spread position. For the March 2023 contract, we sell 5 contract at 4,149 ringgit. At the same time, for the June contract, June 2023 contract, we buy 5 contract at 4,138 ringgit. The initial spread is 4,149 minus 4,138 equals to 11 points. Closing the position later in February 2023, we close both positions. For the March contract, we buy back at contracts at 4,125. Since we sold at 4,149, bought back at 4,125, our profit is 24 points. For the June contract, we sell at 4,130. We originally bought at 4,138. So the result is 4,130 minus 4,138 equals to negative 8 points, which means we lost 8 points. For the total profit, now we combine both positions. Profit from March contract is 24 points. Losses from June contract is 8 points. So our net spread profit is 24 minus 8 is 16 points. Next, we calculate the actual money earned. The formula is net profit equals to profit multiplied with number of contracts multiplied with contract size minus the commission. Our value of profit is 16 points. Number of contract is 5. Contract size is 25 metric tons. So 6 multiplied with 5 multiplied with 25 equal to 2,000 ringgit. Then we subtract the commission. 50 ringgit multiplied with 5 contracts multiplied with 2 transactions equals to 500 ringgit. Therefore, 2,000 ringgit minus 500 ringgit equals to RM 1,500 ringgit. So the final net profit is 1,500 ringgit. So for question B is, what is spread trading? Now I will explain what is spread trading is. Spread trading means buying one future contract and selling another future contract at the same time. The goal is not to make money from the overall market direction, but to profit from the change in the prices difference and the spread between the two contracts. A trader will buy the contract that looks cheaper or undervalued, sell the contract that looks more expensive or overvalued. Why do traders watch the spread? The spread can either widen or narrow. If the spread is widening, the distant contract usually changes more than the nearby contract. If the spread is narrowing, the nearby contract usually changes more than the distant contract. While predicting whether the spread will widen or narrow, the trader can decide which contract to buy and which contract to sell. To conclude, the market is bearish, so we expect the spread to narrow. Therefore, we sell nearby March contract and buy the distant June contract. After closing the position, we earned 16 spread points, giving us a net profit of 4,500 ringgit after commission. Thank you. That is my explanation.
Alright, continue with question 2. In January 2023, we anticipate a requirement for a short-term loan of 30 million ringgit to be drawn down 2 months later, in March 2023. At that time, the 3-month LIBOR rate was trading at 3.60% per annum. However, our bank charges us a premium of 1.75% over LIBOR. This means if we did nothing, our floating borrowing rate will be highly vulnerable to market volatility. To eliminate this risk and lock in our financing cost, we choose to implement short hedge using 3-month LIBOR futures known as the FKB3 contract on Bursa Malaysia derivative. Our first step is to determine exactly how many futures contracts we need to fully cover our exposure. The standard underlying principal value for one FKB3 contract is 1 million ringgit. To find the number of contracts, we use the formula amount of principal required divided with principal value. Plugging in our figures, 30 million ringgit divide with 1 million ringgit, so we get 30 in number of contract. Therefore, our strategy begins by selling 30 March 2023 FKB3 contracts at the prevailing market price of 96.80. By doing this, we effectively lock in an implied interest rate of 100 minus 96.80, so we get 3.20%. Fast forward to March 2023, the market shifts and interest rates rise. The actual 3-month LIBOR climbed to 4.15%, causing the March FKB3 futures price to settle downward at 95.85. At this point, we execute two simultaneous actions. First, we secure our physical 30 million ringgit loan from the bank at the new floating rate, which is 5.90%. Second, we close out our derivative position by buying back our 30 FKB3 contracts at 95.85. Let's look at the financial performance of this strategy to demonstrate its viability. First, because we shorted the market at 96.80 and bought back lower at 95.85, we generate a profit in the futures market. We calculate this using our official syllabus formula: sell price minus buy price times with 100 times with the number of contract and times with contract value, so we get 71,250 ringgit. Meanwhile, in the cash market, our actual interest paid to the bank for the 90-day period at 5.19% is calculated 30 million times with 5.90% times with 90 over 360, and so we get 400,042 and 500 ringgit. To find our net position, we offset the high interest cost with our future profit, which is 400,042 and 500 ringgit minus with 71,250 ringgit, so we get 371,250 ringgit. To conclude, let's look at our net effective interest rate to evaluate if this hedge was viable. As you can see, our final annualized borrowing cost is exactly 4.95%. This perfectly aligns with our target lock in January, which was the 3.20% implied futures rate plus the 1.75% bank premium. This derivative strategy represents a perfect hedge. It completely insulates our company's expansion project from adverse macroeconomic shifts, saving us from paying an unhedged interest rate of 5.90%. As for question B, arbitrage involves taking two opposite positions simultaneously in the both cash market and the futures market to lock in a profit. This activity is possible in the LIBOR and FKB3 markets, regardless of whether the future contract is overpriced or underpriced. Because the underlying cash market operations simply involve borrowing and lending, Specifically, if a future contract is overpriced, a trader will sell it in the futures market while simultaneously initiating short-term borrowing and long-term lending in the LIBOR market. Conversely, if the contract is underpriced, they will buy it in the futures market while executing long-term borrowing and short-term lending in the LIBOR market. However, there is a major regulatory caveat to consider. Unlike commodity futures, where a reverse cash and carry arbitrage might fail due to different conditions, the financial reality here is restricted by local laws because short selling is strictly prohibited in the Malaysian cash market. Executing a reverse cash and carry arbitrage when the market is underpriced is impossible, meaning only standard cash and carry arbitrage is permitted in Malaysia.
Next, for question 3A, the question states that an arbitrager want to obtain a stock portfolio worth 50 million. The current FTSE Bursa Malaysia KLCI is 1,468, while the FKLI future price is 1,485, and the contract will mature in 90 days. The borrowing rate is 4.5% per year, and the dividend yield is 3.5% per year. First, we calculate the fair value of the futures contract. After substituting the value, the fair value is 1,471.62 points. Since the actual future price is 1,485 points, and this is higher than the fair value, it means the future contract is overpriced. Therefore, the suitable arbitrage strategy is cash and carry arbitrage. The arbitrager should borrow 50 million ringgit, buy the constituent stock in the cash market, and at the same time sell FKLI futures contract. The number of contracts used is 673 contracts because the portfolio value is divided by the contract value. After 9 days, the cash index increased from 1,468 to 1,480 points. This gives a cash market gains of 408,790.35. The arbitrager also received dividend income of 431,506.85. However, it needs to pay borrowing interest of 554,794.52%. In the future market, because she sold future at 1,485 points and later closed the position at 1,490 points, the future position give a loss of 168,250. After combining all the cash market gains, dividend income, borrowing costs, and future loss, the final arbitrage profit is 117,181.68 cents. This allows that arbitrage is still profitable even though there is a loss in the future market. Next, for question 3B, the question says that on 27 March 2023, the current price of FKLI is 1,468. 5 FKLI contracts are purchased today. Since the contracts are purchased, this means the trader is taking a long future position. For part 1, if the price increase from 1,468 to 1,475, the trader earns a profit. The formula is selling price minus buying price multiplied by number of contract multiplied by 50 ringgit. So the answer is 1,750 profit. For part 2, the contract maturity date is after 5 days, since 27 March is Monday and there are no public holiday. The date will be 1 April 2023. For question 3, if the price decrease to 1,459 points, the trader will face a loss because the trader bought at 1,468 but the price went down. This gives negative 2,250, meaning the trader suffer a loss of 1,250.
Next, I will present question 4, which is about trading 10 contract of FMG MGF5 future at the price of 109.6. In this question, the investor is optimistic about the 5-year MGS because the market yield is expected to decline. When market yield decrease, bond price usually increase. Therefore, the correct strategy is to buy in the future contract. So the position is long 10 FMG MGF5 future contract at 109.6. First, we calculate the margin. The initial margin is 5,000 ringgit per contract and the number of contract is 10. So initial margin equal to 15,000 ringgit. The maintenance margin is 80% of the initial margin. So maintenance margin equal to 14,000 ringgit. This means the margin balance must not fall below 14,000 ringgit. In this question, there is no margin call because the balance is always above 40,000 ringgit. Now I will explain the market to market calculation. Day 1, the opening price is 109.6. On day 1, the price increased to 109.84. So the investor earned a profit of 2,400 ringgit. On day 2, the price increased again to 109.92, giving another profit of 800 ringgit. On day 3, the price rise to 110.05, so the profit is 1,300 ringgit. However, on day 4, the price decreased to 109.99, causing a loss of 600 ringgit. On day 5, the price decreased again to 109.90, causing another loss of 900 ringgit. Therefore, the total profit is 3,000 ringgit. So, if the investor close out the position on day 5, the total result is a profit of 3,000 ringgit. This can also be calculated directly using the opening price and final closing price. Now, for Roman 2, we need to describe the leverage implication if the investor closes the position on day 4. On day 4, the future price is 109.99. The price has increased from the original price of 109.60. The percentage change in price is 0.36%. However, the margin balance on day 4 is 53,900 ringgit. Compared to the initial margin of 15,000 ringgit, the gain is 3,900 ringgit. The percentage return on margin is 7.8%. This showed the effect of leverage. Even though the future price only increased by 0.36%, the return on the investor margin is 7.8%. In other words, future trading allows the investor to control a large contract value by only paying a small margin. This can magnify profit when the market moves in the investor favor. However, it can also magnify loss if the market moves against the investor. So for overall, the investor made a profit of 3,000 ringgit if the position is closed on day 5, and if the position is closed on day 4, the investor earned a 7.8% return on margin due to leverage. Next, question 4B. I will explain why it's currently not feasible to engage in arbitrage for MGS feature and the condition where arbitrage become impossible. First, arbitrage means making a risk-free profit by exploiting price difference between the future market and the cash market. However, in the current situation, this opportunity does not exist. One main reason is the future price is already very close to its fair value. This means there is no significant price difference between the future price and the expected spot price. Without this gap, there is no profit opportunity. Secondly, the market is highly efficient. In an efficient market, any small price difference will be quickly corrected by other traders. So, arbitrage chances disappear very fast. Third, financing cost and carry must be considered. Holding position in the future market involve interest costs, and this cost can remove any potential profit from arbitrage. Lastly, transaction costs such as brokerage fees and exchange fees also reduce profit. Even if a small opportunity exists, this cost will eliminate it. In conclusion, arbitrage is not feasible when prices are efficient, closely aligned with fair value, and when costs outweigh any potential gain.
Next, I will continue for question 5. So the question 5 require you to establish 4 option strategies using the given OKLI, call and put options. So for the first strategy is to long straddle. For the long straddle strategy, we buy a call option and one put option with the same strike price of 1525. The call premium is 25 and the put premium is 20. So the total premium is 45. This means the investor need a large price of movement, either upward or downward, to make a profit. So the break-even price for the lower is 1480 and for the upper is 1570. The maximum loss is limited to the total premium paid, which is 45 points. This happens when the OKLI's price stay exactly at 1525 because both options have no in-string value. So the strategy is suitable with the investor high volatility, but they ensure whether the price will go up or down. So the graph is show that the lowest point is strike price is 1525, showing the maximum loss of 45. Profit increase when the price move below 1480 or above 1570. For the next strategy is short strangle. For the short strangle strategy, we sell one put option at strike price 1525 and sell call option at the strike price 1550. The premium received from the put is 20 and the premium received from the call is 15. So the total premium is 35. The break even is 1490 and 1585. The maximum profit is limited to the total premium received, which is 35 points. This happens when the OKLI's price stay between 1525 and 1550 because both options will expire early. However, the potential loss can be large if the market moves strongly below 1490 or above 1585. So this strategy is suitable when the investor expect the market price to remain stable or move within a small range. So the diagram show that a flat top between 1525 and 1550, showing the maximum profit of 35. Loss begin when the price falls below 1590 or rise above 1585. And for the third strategy is bull call spread. For the bull call spread strategy, we buy a call option with the lowest strike price of 1525 and sell a call option with the highest strike price of 1550. The premium paid for the call is 25 and the premium received from the selling call is 15. So the net premium paid is 25 minus 15 equal to 10 points. For the break even is 1535. The maximum loss is limited to the net premium paid, which is 10 points. This happens when the OKLI's price below or equal to 1525. So the maximum profit is 15 points. This happens when the OKLI's price rise to 1550 or above. So the strategy is suitable when the investor expect the market price to increase moderately but not strongly. So the diagram shows the maximum loss of 10 below 1525 when the profit increase after 1525. Reach break even at 1535 and become maximum profit of 15 at 1550 and above. And for the last one is bear put spread. For the bear put spread strategy, we buy a put option with the highest strike price of 1555 and sell a put option with the lowest strike price 1525. The premium paid for the put is 25 and the premium paid received from the selling put is 20. So the premium paid is 5 points and the break even is 1550. The maximum loss is limited to the net premium paid, which is 5 points. This happens when the OKLI's price is 155 or above. The maximum profit is 25 points. This happens when the OKLI's price falls above 1525 or below. So this strategy is suitable when the investor expect the market price to decrease moderately. The diagram shows the maximum profit is 25 when the price at 1525 or below. The profit decrease as the price rise, reach a break even at 1550 and become maximum loss of 5 when the price is 1555 or above. Next for the question 1, use long call option strategy because Alisa buys call option on PNM share, expecting the share price to increase. A call option gives her the right but not the obligation to buy share price at RM 11 ringgit. She also pays a premium of RM 1.10 per share. The call payoff is calculated as S minus K, which means the market price minus the strike price. Net profit is calculated by deducting the premium from the payoff. The break-even price is 12.10 ringgit. So Alisa only earns profit if the share price is above 12.10 ringgit. From the day 1 until day 6, she makes because the price is below the break even. On the day 7, the share price is RM 30 ringgit, so she earns a profit of RM 90 cents per share. Next, for the question 2, Alisa exercised the call option on the day 7 when the market price is RM 13 ringgit. Payoff per share is equal to 13 ringgit minus 11 ringgit equal to RM 2 ringgit. After deducting the premium, 2 ringgit minus RM 1.10 equal to RM 90 cents. Alisa bought 10 lots and 1 lot equal to 1000 share. For the total share is equal to 10 times 1000 equal to 10,000 per share. For the total net profit, 90 cents times RM 10,000 equal to RM 9,000 ringgit. In conclusion, Alisa earns a profit because the market price is higher than the break-even price of RM 12.10 ringgit. Her total net profit is RM 9,000 ringgit.